Good afternoon, everyone. It's now 12 o'clock on the nose. Thank you for joining us for 12 Points Academy's March webinar, the Taxman Cometh, Strategies to Minimize Your Contribution to the Government. I'm really honored to have with me today Jim Keefe, CPA from Lee and Crowley. Jim, thank you for joining us.
Thank you for having me.
Love it. And for those of you that aren't familiar with my voice, my name is Christopher Cahill. I'm a partner here at 12 Points, and I run the Family Office Services Group. And we're going to get going here. We want to be respectful of everyone's time. We know that you've got a busy day in front of you all. So let me advance my slides here if I can. Excellent. So that's my smiling face. And as you see here, I specialize in working with family-owned and closely held business owners on all aspects of their complex planning needs, with special focus on business succession, estate and trust planning, gift planning, legacy, and philanthropic planning. So I like to say if it ends in planning, it ends up on my desk. I love what I do. I love collaborating with firms like Lee and Crowley and with people like Jim and others. And again, really pleased that he's able to join us today. So without further ado, Jim, why don't you introduce yourself here?
Good afternoon, everyone. Jim Keefe, tax partner with Lee and Crowley. Been doing this for over 15 years, working with small and medium-sized business owners in construction, engineering, real estate, professional service, and manufacturing firms, mostly compliance and planning areas. Yep.
I'm sorry, go ahead, Jim. It sounds like, I feel like I cut you off there.
No, I was just going to transition from there, so I'll let you.
Okay, great. Yeah. So again, we're really pleased to have Jim here today. He and his firm are good collaborators and friends of ours here at 12 Points, do a lot of work together. And, you know, they're in Massachusetts, but Jim, if there was somebody that was located in a different state, would you be able to talk to them and help them?
Absolutely. Prior to Lee and Crowley, I was with a national firm working with clients throughout the U.S. I've prepared returns for clients in 30+ states.
Excellent. Thank you so much. All right. So out of an abundance of trying to pay attention to time, excuse me, let's just get going here. So taxes, we're in the midst of tax season now, obviously, and thank you for taking the time out of your schedule to do this. As we know, the April 15th deadline is upon us. You just rolled through the March 15th deadline the other day. What sorts of things should we be thinking about for 2023 and or 2024 more likely going forward, right?
Right. So for 2023, for most people who are employees, the ability to, save or defer income on taxes is pretty limited at this point because the year is closed. There are a couple of options available for small business owners in terms of, making contributions to retirement plans prior to the filing of their return. But in terms of 2024, if you're an employee of a company and a couple things you can be thinking of throughout the year to minimize your taxes or exclude as much income from taxable income as possible. And, basic 5 that you're going to see with most employers, there are going to be a retirement plan of some sort. One of the most common is a 401k plan. It allows employees to put aside a portion of their income annually, and the cap for 2024 is $23,000. So this is your elective deferral, and what it does is it reduces your federal income wages. It's still included in your FICA and Medicare wages, but it gets excluded from the wages that are subject to federal and state income tax. In addition, if your employer offers any sort of match, it's always great to put aside as much as you can through an elective deferral, because if their match is based on what you put aside, the more you put aside, the higher the match usually is. Next benefit that most employers are offering that you'll see is a health savings account.
Before we pivot to that one, Jim, let's just take a second and scroll back to the 401k. So 23 on the contribution today, but if we're over 50, there's a catch up, right? So those folks can add more, right?
Yes. Yep. And I believe that number is,
I think it's 7,500 this year, isn't it?
think that's right. It's now indexed to inflation, I believe, so that actually can increase. So, yep.
Right, perfect. And then the other point that I wanted to make as it relates to the 401k, and this might be appropriate for some of the listeners, maybe not everybody, but many plans offer the option for a Roth contribution. So if we're, our primary motivation is to minimize taxes, the traditional contribution, the methodology that Jim just outlined would be the way to do that, because that would, have a tax deductible contribution. That amount that you contribute would be taken off of your AGI. But if you were to elect Roth, that would not be tax deductible, but it would be a tax-free benefit that you would receive in the future. So those are things that, certainly planning warrants conversations around. So if that's something that's of interest to you, to figure out whether or not you should be using a Roth, or to what degree you should, maybe in conjunction with the traditional, those are the things that both Jim and us here at 12 Points can help you with. So I just want to make sure that we address that while we had that topic there, Jim. So let's move to the HSA.
Yeah, great point. Thank you, Chris. HSA is another qualified deferral vehicle, but the benefit of this is it's supposed to be used for medical expenses that you incur. It's a health savings account, which is different than the FSA, the spending account. It allows you to put aside money annually if you're in a high deductible plan. Now, most of us, unless we're a union worker for EPS, are in high deductible plans this year. If your single deductible is $1,600 or a family, the deductible is $3,200, your plan qualifies as high deductible, and you would be able to contribute to an HSA. The amounts you can put aside are either $4,150 if you're a single filer, or $8,300 married filing jointly. And what's great about the HSA, you can put this money aside annually. You don't have to use it annually because it's a savings plan. I have a number of clients that are actually using this as another deferral vehicle, and they're not necessarily drawing down on it. Maybe they plan to draw down on it later in life when they think they'll be incurring more medical or health expenses.
And I would simply echo to that point there, Jim, that this is one of those under the radar sort of savings vehicles that oftentimes many people just aren't aware of. But the utilization of an HSA for somebody that's got good income and they're maxing out their 401k and they're otherwise maxing out IRA funding is a really great tool to not only get tax deductibility, but to provide for those future expenses as they relate to health insurance, healthcare. So this is definitely something to pay attention to. It's something that many people aren't aware of. The money that is contributed to these accounts can be invested and can grow. So if this is something that you're moderately familiar with or maybe not familiar with at all, again, either of us can help you think this through and decide whether or not it makes sense.
Great, thank you. Next item is the flexible spending account. This is very different than a health savings account in that it has a lower contribution amount. Max you can put in is $3,200 per individual or per spouse, and it also has a use it or lose it element to it. So if you don't use it all in the current year, you could potentially lose it. However, a lot of plans have one of two grace periods or carve outs, so you don't lose everything. Your plan can either offer a two and a half month grace period. So as long as you spend everything that's left within 2.5 months of the following year, you don't lose it. Or they could allow you to roll over up to, I believe for the current year, $640 to the following year. So key difference between this and a savings account is you have to spend it. Otherwise, it stays with the trustee who's ever managing the plan. And when I say that, I mean, it's not the employer, it's the fiduciary that's holds the assets.
I'll tell you, I had a flexible spending account many years ago, and that deadline comes up quick. And it was a year that we candidly didn't really use a lot of health coverage. So there was a pool of money in there that hadn't been utilized, and I was at risk of losing it. So I'll never forget, I went to CVS and I was buying everything on the shelf to try and stock up for the next year. And the manager came over and asked me what I was doing. And I told him I'm using my FSA account, and he had never heard of it, of course, and thought that I was in the process of doing something weird with all these medications I was buying. So don't put yourself in that position. If you're using an FSA, please make sure that you use it and don't leave it to the last minute like I did.
Great point, thank you. So after the FSA, a lot of employers offer a childcare FSA. The first one, the FSA we're referring to in the context that is supposed to be used for medical dental expenses. A childcare FSA allows you to put aside monies for dependent care for any child under the age of 13. Now, as any of you know that have children, you can get a dependent care credit on your tax return. Most people, depend on your income level, the max credit some people can get is $600, and it works out to 20% of up to $3,000 of qualified expenses. Using a childcare FSA allows you to put aside more money for childcare, and you could, if you're paying a large amount in daycare, you could still get the $600 credit. So for instance, if the cap right now is $5,000. So if you're going to incur $8,000 in daycare, and I'm sure some people are spending way more on that, you would take $5,000 off the top, and you'd still have $3,000 of qualified expenses left at the end of the year that would qualify for the credit. So it allows you to use more money pre-tax for dependent care that you wouldn't otherwise get the benefit of because of the cap on the credit.
Excellent.
Last item on this page I wanted to talk about is just withholding changes. Whenever you have any sort of life event, you always want to stop and think if you need to make any adjustments to your withholding. If you get married or divorced, is your withholding based on married, family, jointly? Is it based on single? If both spouses work, there's a box to check that there's two sources of income, so to withhold at slightly higher rates. I see a lot of people forgetting to check this box, and when you have a two-income household, when you add their incomes together, they get pushed into a higher tax bracket. So making sure at least one checks the box to have withheld at the higher rates. And also, sometimes it just doesn't make sense to put a 1 down or 2 down for your number of dependents because maybe your child tax credit phases out. Unlike the dependent care credit, there is an income threshold on the child tax credit. So if you know your income's pushing north of 400 jointly with your spouse, maybe not claiming a child and over withholding, because you're not going to get the benefit of that credit at the end of the year.
Great point, thank you. So let's pivot and discuss the world of Secure Act 2.0.
So a lot of people haven't been paying attention. Secure Act came in hot and heavy in 2022, but not everything took effect in 2022. A lot of these tax changes took effect either 22, some in 23, some in 24, some in 25. So I just want to touch on a number of these changes that have been taking place. So the first one I want to touch base on is an automatic enrollment provision for plan years beginning after December 31st, 2024. So this is an issue for next year. And it's not all plans. This is just supposed to be for new plans that are starting. So
when you're referring to plans here, Jim, just so that everybody's clear on it, we're talking about retirement plans, correct?
Yes, exactly. We're talking specifically about 401k and 403b plans specifically. So any new 401k or 403b plan after December 31st, 2024 now requires automatic enrollment of at least 3%, but not to exceed 10% for each enrollee, which would be any eligible participant. And after that, it's supposed to increase by 1% until it reaches a total of 10%, but never more than 15. There are limitations, of course, so as to not create, a burden on employers. If you are a small business with 10 or fewer employees, you're exempt from this requirement. And also churches and governmental units are also excluded from this new requirement. If you are The next item, the next point, small business startup credit. If you are a small business, have 10 or fewer employees, and you want to take advantage of this automatic enrollment and set up a plan, the government's trying to incentivize you to. So they have a startup credit, which is supposed to cover up to 100% of the eligible costs of administering a 401k plan. So in prior years, it was a 50% credit with a maximum annual credit of $5,000. This is now increased to up to 100% of the eligible costs. In addition to that, there's also now a matching credit. So you could get a credit for both establishing a plan and for making contributions to your employees' retirement plan. Another item to touch on is the increased age requirement for RMDs. Prior to Secure Act 2.0, the age was, I believe, 72, and they increased that to 73 starting 1/1/23. And then in 2033, the age requirement is going to increase to 75. Now, there have been some guidance that's come out regarding if I turn 72 in 2022 or I turn 72 in 2023, what impacts me? When do I have to take my required minimum distribution? So in March of last year, the IRS came out with guidance stating that IRA owners who attain 72 in 2023 will have a required beginning date of April 1st of 2025 instead of 2024 when they will need to take their RMD. And then another addition, another change is the treatment of student loan payments as elective deferrals for employer matching. So previously, an employer matching was based on what the employee's elective deferral was to their retirement plan. Now, you could have an employee that is making payments on student loans, and if the plan permits it, if the plan's amended to include this provision, if the employee certifies to the employer what they're making, to what they're paying on their student loans, the employer can use that in calculating the match. That is for years beginning on or after December 31st of 2024 also. So that's, we're looking at plan years beginning in 2025. You could take advantage of that. And like I said, I believe the plan has to be amended to include language on that.
That's super exciting for so many reasons. I mean, there's so many people with these loan payments out there, so great benefit there.
Okay. All right. So next page is also more changes that are part of the Secure 2.0 Act. So beneficiaries of a 529 college savings account can now roll over up to $35,000 over the course of their lifetime from a 529 account in their name to a Roth IRA. So if you have someone for whatever reason didn't expend all their money on college, chose not to go to college, went to a trade school, or just did something else, and there's money left at the end of the day, because let's be honest, if you went to college, there's probably no money left in that account. You can now put that money aside in a retirement plan. The same rules apply for a Roth contribution. So there is a maximum limit you can do annually. You can't just roll over the entire $35,000 all at once. And this is also available starting in 2024, actually.
That's great. Huge benefit.
Yeah, absolutely. Next item, reduction in excise tax on certain accumulations and qualified retirement plans. If a participant failed to take an RMD, they are typically subject to a 50% penalty on what that RMD was. The Secure 2.0 Act reduced that penalty down to 25%, and it also allowed participants or taxpayers 2 years to correct the failure. So if you do make the RMD within 2 years, the excise is then reduced from 25% down to 10%. So a lot of people just aren't thinking of it when they turn 72. Sometimes it's just not on their radar and things get missed. So this is, a great way not to penalize people. And then I'm sure people have heard of the exceptions from, taking distributions from an IRA. You usually need some sort of qualifying event, separation from employment, death or disability, things of that nature. They've now added a new exception for terminal illness. Not much to add on that per se. I just wanted to point that out.
Well, thank you. Hopefully that doesn't apply to any of the people on this call or anyone they love.
Exactly.
So here, charitable deductions, this is some of my favorite stuff. Let's jump into this.
Awesome. Yep. So charitable deductions are great. Federally, you need to itemize to take advantage of charitable giving. So with standard deductions now, married filing jointly being 29,000 and change, and state and local taxes being limited to 10,000. It's really about, if you're altruistic and you want to give for the sake of giving, absolutely. But if you're trying to look for a little tax savings at the same point in time, sometimes it comes down to managing your contributions year over year to get the maximum bang for your buck or benefit. So first thought, planning opportunity is called bunching, which is literally just bunching as much as you can into 1 year, and then maybe just taking the standard deduction the following year. Next opportunity is a donor advised fund. And that's similar to bunching in that you create a donor advised fund and you make contributions to that fund. You get the deduction when you make the contribution to the fund, and then the fund can disperse amounts to charities at the time and manner it sees fit. So just because you put 50,000 into the donor advised fund or 20,000 doesn't mean it all goes to the charity at that point in time, at that year. It can be spread out.
And that's one of those tools that we use quite regularly here at 12 Points to assist our charitably inclined clients. People oftentimes will come in and say, hey, I want to make gifts to charity, but maybe I don't know where I want to give it to, or they have a big payout and they're looking to take advantage of a deduction in 1 year and spread those distributions out over the future. A DAF is a really cool technique and tool for that. So we're particularly skilled in utilizing those.
Next planning strategy is contributing securities versus cash. If you have securities that have appreciated in value, if you were to sell that security and then contribute that cash, you now have a taxable event and you're recognizing gain on the sale, on the realized gain. Whereas if you contribute the security either to the DAF or a charity that accepts securities, stock, you don't have to realize the appreciation in income, but you would get a deduction for the full fair market value. There is a caveat, of course, whereas any cash donation is limited to 60% of your adjusted gross income. Donation of appreciated property is limited to 30% of your adjusted gross income. I haven't seen many situations where I've hit that cap, but it does happen once in a while when there is donations of appreciated property. Finally, qualified charitable distributions. If you have an IRA and you want to make a contribution and you've attained the age of 70 and a half, you can contribute up to right around, I believe it's $100,000 annually to a charity. And instead of taking an itemized deduction for the charitable contribution, it reduces the taxable amount reported from your IRA. So in effect, you're reducing your adjusted gross income. In Massachusetts prior to this year, that's great because it would have stayed out of your income, whereas before 2023, you could not deduct charitable contributions at the individual level. That things changed in Massachusetts. You can now deduct charitable contributions, but there are still benefits in terms of qualifying. For instance, if you're, lower AGI usually qualifies you for other benefits versus itemizing deductions. So to the extent you have the ability to do a QCD from your IRA versus doing it outside of the IRA, take advantage of that.
Yeah, it's certainly one of our favorite techniques, especially for our wealthy clients that don't need the distributions and they've just been stockpiling them away, and now they're being forced to take these distributions out and they're philanthropically inclined otherwise. I mean, it's a perfect spot to go. So, yeah, obviously with any sort of charitable conversation, the big question is, what is the impact you're trying to achieve? As most of you know, I am a chartered advisor in philanthropy and that's an area that I love to spend time talking about. So if you ever have an interest in talking about the impact that you're trying to make with your wealth, please reach out. And now we're going to pivot over to important life events.
Okay, so 3 pictures here, pretty self-explanatory. You know, a couple gets married. First thing you always want to think about is, you know, how are we adjusting our withholding? Are we getting, you know, some people say there's a marriage penalty because of the way the tax brackets are shaped up, or just because not everything doubles in terms of eligible for deductions or credits. So just understanding your withholding when you get married. The birth of a child, there's a child tax credit, so that's also something that's tied into your withholding. You claim the credit on your return, but because you're getting that credit, the IRS lets you adjust your withholding to account for that child. So in effect, you're getting the benefit of the credit through every paycheck. And then purchase of a home, sale of a home. With mortgage interest, a lot of people have the ability to itemize versus take in the standard deduction. And with the interest rates going up right now, you're going to see itemized deductions start to creep up over prior years. Keeping in mind that with loans, there is a cap of $750,000 of principal that you can deduct interest on. So can't go out and buy a $2 million house and deduct every dollar interest, unfortunately. The principal amount would have to be below $750,000 or less in order to deduct the full amount of interest.
Great point, thank you. How about investments and taxes?
Yeah, so some great things with investments. If you have an investment account and you know you have gains for the year, or even if you have gains from something else that are capital in nature. I have a couple clients whose father passed away, unfortunately, a couple years ago. They finally got around to selling the house. They've got some gain on that, and you know, they look to their financial advisor to see if there was any losses in their account they could harvest that would help offset that gain. And then on the flip side, Chris can explain in more detail why you would want to take losses from something if, you know, out of your account.
Yeah, sure. So, I mean, obviously, as Jim just indicated, you know, the opportunity to reset a portfolio, if you've got big winners, whether it's, you know, some things that have improved over time and increased over time, being able to diversify the portfolio, reduce the exposure to those positions. You want to offset those gains with losses. In other positions, you can simply sell the losses and the gains, wash them against one another, reduce the tax exposure, and then give yourself, you know, this comes into the wash sale rule here, give yourself 30 days after the sale of the position that was at a loss, you can buy it back, or you could buy a replacement stock in between if you'd like. And that would really give you the ability to offset the gain, avoid capital gains to the extent that you can with the losses, and then re-enter that stock that you've sold at a loss, should you choose to, 30 days down the road. So from our perspective, that's just good housekeeping and stuff that we like to pay attention to. Oftentimes that's a year-end sort of thing, but you know, last year, for instance, it was something that we were paying attention to throughout the year because it was kind of a volatile year mid-year. So.
Thank you. And then the last item on the page is holding period. A lot of people who hold stock, you want to hold it for at least a year to get long-term capital gains rates. Anybody who has any sort of equity compensation as part of their company, whether it's stock options or RSUs, holding period is something you want to think of before you start unloading that equity. You know, will there be additional benefit if you hold it for a year? If the property's going to maintain or the stock's going to maintain its value or increase in value, holding it past a year would, you know, save you between the ordinary rates and capital gain rates. Just kind of as a refresher, ordinary rates can go as high as 37%. And in Massachusetts, the short-term rate, it used to be 12%, just dropped down to 8.5%. So if you're able to hold the stock for a year or more, those rates would then decrease. In Massachusetts, that 8.5 goes down to 5%, and federally, that 37% goes down to a max of 20%. So there's definitely benefit to being able to, you know, hold on to that stock for a year instead of just flipping it within a year.
Great point. Great point. And can you spend a second, Jim, talking about, so as we're talking about long-term gains and or short-term gains, how about long-term losses and short-term losses versus how you could use those to offset? Is that something that we should touch on?
Yeah, so capital losses and capital gains can offset each other regardless of the holding period. So short-term always offsets short-term, and then the excess goes to offset long-term and vice versa. So yeah, it can all net together at the end of the day. Yeah, I don't think.
Perfect. Well, appreciate that. And as we look here at the next slide, we've kind of touched on that, I think, already.
Yep.
And then let's talk about these additional tax deferred savings vehicles. So as you touched on at the very beginning of the presentation, there's not a lot that can be done for 2023 for most folks, except they could make a contribution to a tax deductible IRA if their compensation was such that they were able to do that, correct?
Absolutely. Yep. So you can either make a tax deductible contribution to an IRA, or if your income's over the threshold, you could still make a non-deductible contribution to a traditional IRA.
Mm-hmm. Which we absolutely like doing nonetheless. Roth IRAs, we kind of touched on this as it relates to the Roth 401k, but please let's get into that.
Yeah, so with a Roth IRA, you're making after-tax contributions to the Roth, and the benefit of that is when you retire and you can start taking distributions, it comes out tax-free. It's not going to be subject to federal or state income tax. There are limitations, of course, on what you can contribute, and that is also based on income, also has income limitations as well. So a lot of people aren't able to make a standard Roth contribution because of their income level, but there is a workaround called, a backdoor Roth, whereby someone makes a contribution to a traditional IRA and then converts that into a Roth IRA. So you're making a non-deductible contribution, and then that distribution unit, because it's non-deductible, gives you basis, so you don't have no tax pickup when you then distribute that traditional IRA into a Roth plan.
Perfect. And that's one of my favorite savings vehicles, candidly. I think that the future you will love Roth to the extent that you can put money into Roth. I think that's generally a good thing. And these SEPs.
Yeah, so SEPs are self-employed pension IRA plans. It allows a self-employed individual to contribute to a plan in excess of your traditional IRA limitations. So a SEP person could put aside in 2024 up to $69,000 in a SEP plan. It's limited to 20% of your compensation. So as long as you have $340,000 of income, you could put aside $69,000 into a SEP plan during the year.
Nice. And how about these solo 401ks?
And then, yeah, a solo 401k, so that's an individual. What solo is really for a self-employed person that wants to do a 401k instead of a SEP. If you have no employees, so if you're a sole practitioner or just mom and pop shop with no employees, you can have a solo 401k plan. You're the only participant in the plan, and similarly, you would have the elective deferral as if you were any other employee, and then you could have the employer match a profit share component, which you could use to get all the way up to that $69,000 total contribution amount.
Excellent, excellent, thank you. And it's a powerful vehicle for certain. And we touched on capital gains taxes a minute ago. Certainly, really, really important to pay attention to, especially as the market continues this steady march up. There's concentrated wealth, and probably heard of these positions, the Magnificent Seven. Can't tell you how many people I'm seeing that have just big allocations to small positions. So those gains need to be paid attention to. And of course, estate taxes, right? So you guys that know me know that I'm passionate about estate planning. Nothing I enjoy more than talking to people about how to plan for the future of their wealth, passing it through the generations. So this is something that is currently a hot topic. From a federal tax perspective, we've got the Tax Cut and Jobs Act that is has increased the federal estate tax exemption from around $5.5 million to $13.61 million per person currently. So a married couple can move about $37 million, $27 million federally estate tax free currently under the current law. That's set to sunset on December 31st of 2025. So we've got a situation whereby you've got a window to plan if you've got significant wealth. If that law sunsets, and it will, unless there's new changes that come into being between now and then, the estate tax exemption will revert back to what it was before, with a bit of an inflation adjustment. So most practitioners think if we get a sunset that it'll be around 7 million per person. So you'll go from 27 million of available exemption down to around 14. So losing about 13 million that you could pass to your heirs should you have that type of wealth now. So that's where I'm spending a lot of my time, is helping people with the estate planning to make sure that that amount is covered and protected, and that we're being thoughtful as it relates to making gifts now. So this is an area that is kind of under the radar for a lot of folks. I would urge you not to wait. I did some calculations the other day. We're at about 400 days, working days, non-holiday work days between now and December 31st, 2025. Those days will move quickly. I've seen this picture before. So if you have substantial wealth and you're interested in being smart about it, let's start planning now. And let's pivot here, Jim, over to the state stuff. So this is Massachusetts oriented. So those of you that are maybe out of the state, I see a couple of you in California, for instance. This is not specific to you by any means, but take us down this road here, Jim.
Sure. So 2022, 2023, big year for tax changes in Massachusetts. Short-term capital gain rate decreased from 12% to 8.5%. Deduction for contributions to a Massachusetts 529 plan. As everybody knows, the money in the 529 plan grows tax-free, and you don't pay taxes on it if you use it for qualified higher education. So the IRS never gave you a deduction for those contributions. The state is allowing you a deduction, and I believe it's capped at $2,000 a year. Deduction for charitable contributions, starting in 2023, charitable contributions, cash charitable contributions, non-cash don't count, are now deductible in Massachusetts, whether you itemize or not. So this is something I'm struggling to remember to ask my clients on a regular basis. I'm so used to the ones that take the standard deduction, not being able to claim the charitable contribution. Now we got to step back and remember, okay, we can still get the benefit at the state level.
Great point.
Yeah, new estate tax credit of $99,600 helps. So what this does is it, in essence, allows the estate a Massachusetts estate to be tax-free for up to the first $2 million of value, and then anything over that would then be subject to the Mass estate tax. And that's really great because with property values soaring, people that were getting pushed into the $1 million bracket pretty quickly. So this now creates a little bit of a buffer for that middle class that otherwise wouldn't have been subject to the Massachusetts estate tax.
It's crazy it took so long to get there, but that is a material increase in benefit to those of us in Massachusetts for sure.
Now, anybody from Massachusetts knows I forgot to put something on this bullet point, but it actually ties hand in hand with this last item: joint filing requirement for married couples. So last year, and for 2023, Massachusetts implemented a millionaire's tax. It's a 4% surtax when your income was over $1 million. So of course the workaround was, let's file separately and let's try and keep our combined income under $1 million each. So starting in 2024, married couples who would otherwise be allowed, all married couples, whether you're over $1 million or not, if you're If you file jointly federally, you have to file jointly in Massachusetts, whereas prior to that, you could file one way federally and a different way in Massachusetts.
Mhm. Great point. Great point. So what's the impact that you're seeing on the mass millionaires tax for those folks that squarely fall within that? Personally, we here have been seeing many of our clients up and move and just move to greener pastures, i.e. Florida, Texas, etc. How much are you seeing that in your practice, if at all, Jim?
So most of my clients are small business owners. They don't
They can't
have
move the
taxable
business so easily, right?
Yeah, it's hard to relocate a business. If you have passive portfolio income or your income's not tied to Massachusetts, changing residency will help. But if you have your entire firm, office, HVAC, plumbing company, whatever, is based in Massachusetts, unfortunately, people are just biting the bullet on this one.
Mhm.
You know, it's not worth the cost of relocating everything.
No, understood. Understood. Well, thank you for that. And here's a quick spot that you can find Jim if you have any questions and want to follow up with him. You can get him directly at that email address or his phone number, 617-356-8220. And of course, you know where to find me here, Chris at 12pointswealth.com, 978-318-9500. Thanks so much, Jim. I really appreciate your time and effort in this present as always. We're now at 43 minutes. I'm going to let everybody move on with their day. Should you have any questions, folks, don't hesitate to reach out to us. Thanks so much, Jim. Talk to you soon.
Thank you.